Good evening, guys. Today we'll start with Unit 2 of Financial Risk Management, Banking Specialization, MBA 4th semester subject. And we'll be discussing about various things in derivatives. This unit talks about Introduction to Derivatives. There are 6 things which have been mentioned in the syllabus, that is history, major exchanges, features, participants, types of futures, then mechanism of future markets. So it is more related to exchanges and futures. So we'll study about derivatives in this unit. Let us go ahead with this. First of all, let us understand what is the meaning of derivative. A derivative is a financial security with a value that is reliant upon or derived from an underlying asset or group of assets, a benchmark. The derivative itself is a contract between two or more parties, and the derivative derives its price from fluctuation in the underlying asset. First of all, we have to understand what is derivative. Derivative is a financial contract. It is a contract between two or more parties, and it is a contract which derives its value from some underlying asset, some benchmark. For example, you can have a derivative, a piece of paper, the price of which depends or fluctuates with the rise and fall of the prices of potatoes. Now there will be a derivative based on the commodity potato. So similarly, there will always be some underlying asset on which the price of the derivative is dependent, and it will fluctuate accordingly, and that is the benchmark, and it is a financial contract. The most common underlying asset for derivatives are stocks, bonds, commodities, currencies, interest rates, and market indices. So what all can be underlying assets? What all can be the assets on the basis of which a contract can be drawn, and on the basis of that contract the price or of the contract will fluctuate. These are stocks, bonds, commodities, currencies, interest rates, and market indices. Now these assets are commonly purchased through brokerages. So there will always be, if you are going through some broker, then there will be some brokerage involved while purchasing these assets. Let us go for derivative types. How many types of derivatives are there? Mainly, there are 4 types of derivatives: forwards, futures, options, and swaps. Let us understand what do these means. Let us assume let us understand what forward means. Forward is a financial contract which has which has to be executed in the future, which is entered today and it is to be executed in the future, and it will have a definite date of execution. So that is forward. If it doesn't have any definite date, it can be within 3 months, 4 months, then it is futures. Then options, you may have option of buying an asset, that is call option, or selling an asset, that is put option. Now swaps. Swap means when the liabilities of the people, they swap the liabilities. For example, I've got a friend Ram in Japan, and I've taken some loan in Japan in Japanese yen, and Ram has taken some loan from India in India, and that is in INR. Now if I pay my loan in Japanese yen and Ram pays it in INR, we both are exposed to foreign exchange risk. How we can overcome this risk is, I can ask Ram, okay Ram, can you pay my loan there in Japan, and in exchange I will pay your loan here in India in INR. That way we can exchange interests, we can interest swaps, and that is how it works. We'll study these things more in detail, because let us understand again what does the forward means. Forward means, for example, I'm an exporter, and I want to buy some. Yeah, I'm an exporter, and I'm expecting some dollars to come in after a month. Now, I'm a bit worried that dollar may not do good, and maybe I would get less price for surrendering my dollar in the future because dollar will not be doing good. So what I can do is I can enter in a contract with a bank that today that you buy my dollars after 1 month at a predetermined price, which we'll decide today, and can you please buy that for me in the future? And if the date is fixed, for example, it is 30th of June, then that is forward contract. And if the date is not fixed, it may be like, okay, I'm exporting and maybe I'll get my money in next 3 months. Now date is not fixed, but yes, the range of dates is fixed. This is futures. So this is how forward and future market works. Now options. Now for example, I may enter with the same when let us look into the same transaction where I was dealing with a bank that will you be able to buy my foreign exchange in the future. I make a deal with a bank that if dollar goes bad, I would buy it from you, and if dollar goes good, it may be other way around. It may be like, okay, dollar may do good and rupee may not do good in comparison to dollar. Then what I can do is I can buy it from market. So here I have got option. I've got option to whether buy it or to sell my dollars or not. So here the option to sell is put option. So that is how options work. Now let us move to spectrum of derivative contracts worldwide. If you look into this, I've taken 4 underlying assets: equity, interest rate, credit, and foreign exchange. Equity can be index future or stock future. Types of derivatives are exchange traded, again exchange traded, over the counter swap, over the counter forward, and over the counter options. Now if you look into equity, it can be index future, stock future, index option, equity swap, back to back repo agreement, or stock options warrants. If you look into interest rates, it's interest rate future linked to MIBOR. MIBOR is Mumbai Interbank operations rate. Then futures, options on futures. Options on futures, interest rate swaps, forward rate agreements, interest rate caps, floors and collars, swaptions. Now look into credit, then it will be bond future, options on bond future, credit default swap, total return swap, repurchase agreement, credit default options. Foreign exchange, it can be currency future, option on currency future, currency swap, currency forward, and currency options. So you just have to add whatever the type of derivative market contract is there. For example, equity, then equity exchange traded derivative for index futures and stock futures, interest rate futures linked to MIBOR, bond futures, and currency futures. So you just have to add futures. Exchange traded, it will be index options, options on futures, options on bond futures, and options on currency futures. OTC swap, it is over the counter swap. Equity swap, I would recommend you to go to Google and Google all these terms and note down in a notebook what is the meaning of these terms. Equity swap, interest rate swaps, credit default swap, total return swap, currency swap. Then over the counter forwards, it is back to back repo agreement, forward rate agreement, repurchase agreement, currency forward. And OTC option is stock options, warrants, interest rate caps, floors and collars, swaptions, credit default options, and currency options. So these are the spectrum of derivatives contract worldwide. Now, commonly traded derivatives. First one is forward contract, an agreement between two parties, a buyer and a seller, to purchase or sell the underlying asset at a later date at an agreed price. The buyer is said to have gone long and seller to have gone short. So then futures contract is an agreement between two parties, a buyer and a seller. However, unlike forward, futures trade on organized exchanges and are subject to daily margin and settlement procedures by a clearinghouse. Futures coverage include currencies, financial securities, agriculture, and other commodities. Options contract. These contracts can either be call or put options. Call options give the buyer the right but not the obligation to buy a given quantity of the underlying asset at a given price on or before a given future date. The cost of buying an option is the seller's premium, which the buyer must pay to obtain the option's right. Put options work in the same way as the call options, but in the case the buyer has a right to sell the underlying asset in the future. We have already discussed this with an example. Swaps are the private agreements between parties to exchange cash flows in the future. The most commonly used swaps are equity, interest rate, currency swaps. For example, under an equity swap, the amount paid or received will be difference between the equity price at the start and end of the contract. Now let us go to the history of derivatives. The derivatives market can be traced back to the Middle Ages. They originally developed to meet the needs of the farmers and merchants. The Chicago Board of Trade was the first derivative market established in 1848 to bring farmers and merchants together. Initially, its main task was to standardize the quantities and qualities of the grains that were traded. Within a few years, the first futures type contract was developed. It was known as to arrive contract. Speculators soon became interested in the contract and found trading the contract to be an attractive alternative to trading the gain itself. The Chicago Board of Trade now offers future contract on many different known as to arrive contracts. Speculators soon became interested in the contract and found trading the contracts to be an attractive alternative to trading the grain itself. The Chicago Board of Trade now offers future contracts on many different underlying assets, including corn, ore, soybean, oil, wheat, silver, treasury bonds, and treasury notes. The Chicago Mercantile Exchange. In 1874, the Chicago Produced Exchange was established. This provided a market for better eggs, poultry, and other perishable agricultural products. In 1898, the buffer and the egg dealers withdrew from this exchange to form the Chicago Butter and Egg Board. In 1919, this was renamed the Chicago Mercantile Exchange and was reorganized for futures trading. Since then, the exchange has provided a future market for many commodities including pork, bellies, live cattle, live hogs, and feeder cattle. In 1982, it introduced a futures contract and a euro-dollar futures contract on the S&P Standard & Poor's 500 stock index. The International Monetary Market was formed as a division of the Chicago Mercantile Exchange in 1972 for the futures trading in foreign currencies. The currency traded on the IMM now include the British pound, the Canadian futures dollar, the Japanese yen, the Swiss franc, the German mark, European euro, and the Australian dollar. The IMM also trades a gold futures contract, a treasury bill futures contract, and a euro dollar futures contract. Other exchanges. Many other exchanges throughout the world now trade futures contracts. Prominent among them are Chicago Rice and Cotton Exchange (CRCE), the New York Futures Exchange (NYFE), London International Financial Futures Exchange (LIFFE), Toronto Futures Exchange (TFE), Singapore International Monetary Exchange (SIMEX), and National Commodity and Derivatives Exchange (NCDEX) of India. Now, history of derivatives in India. The history of organized commodity derivatives in India goes back to the 19th century. Cotton trade associations started futures trading in 1875, oilseeds in Bombay 1900, raw jute and jute goods in Calcutta at that time, wheat in Hapur, and in bullion in Bombay, 1920. Speculation with a view to restricting speculative activity in cotton market. The government of Bombay prohibited options business in cotton in 1939. Later in 1943, forward trading was prohibited in oilseeds and some other commodities including food grains, spices, vegetable oils, sugar and cloth. Parliament passed Forward Contracts Regulation Act 1952. The Act applies to goods which are defined as any movable property other than security, currency, and actionable claims. The Exchange FMC, Department of Consumer Affairs, Food and Public Distribution, is the ultimate regulatory authority, three-tier authority for derivatives. So, here we come to the end of derivatives, history of derivatives. Now, if you look into derivative market landscape, how it looks like, there are two kinds of derivatives: exchange-traded derivatives and over-the-counter derivatives. Exchange-traded derivatives are the derivatives which are traded on the stock exchange, and over-the-counter derivatives are the derivatives which are traded over the counter between buyer and the seller. There are two main types of exchange-traded derivatives: commodity derivatives and financial derivatives. If you look into commodities, soft commodities, metals, and energy. Then livestock and new commodities. Financial derivatives are of three types: equity financials, interest rates, and currency derivatives. Soft commodities consist of crude palm oil, soya oil, orange juice, and coca. Livestock consists of cattle. Metals consist of gold, silver, uranium, and tin. New commodities include plastics, weather, it has to be leather, freight rates, electricity. Weather commodity. Energy includes crude oil, natural oil, heating oil. Financial derivatives consist of three parts: equity financials, currencies, and interest rates. Equity financials are Standards & Poor's, S&P, single stock futures, FKLI, and currencies consist of euro dollar and dollar Japanese yen currencies. So this is the market landscape of derivatives. There are mainly two kinds of derivatives: exchange traded derivatives and over the counter derivatives. Exchange traded derivatives are again of two types: commodities derivatives and financial derivatives. Commodities derivatives are of five types: soft commodity, livestocks, metals, energy, and new commodities. And financial commodities are of three types: equity, financials, interest rates, and currencies. Now, major stock exchanges, top 20 stock exchanges. If you look into this, it is New York Stock Exchange, United States, NASDAQ. First of all, let us understand what is stock exchange. A stock exchange is a secondary market where already issued shares are traded between various investors at a market price. Nasdaq is United States, Japan Exchange Group, Tokyo, Japan, Euronext, Netherlands, France, Belgium, Portugal, London Stock Exchange Group, United Kingdom, Italy, Hong Kong Stock Exchange, Hong Kong, Shanghai Stock Exchange, China, TMX Groups, Canada, Shenzhen Stock Exchange, China, Deutsche Börse, Germany. So these are major stock exchanges. I've mentioned top 10 over here. Features of derivatives. First of all, it is contract between two parties. Its value is dependent upon the value of the underlying asset. There's a specified obligation. Types of trading, there can be over the counter or exchange traded. There's no physical delivery of the goods. It is just the exchange of contract. Deferred payment instrument. The payment can be deferred, it can be paid, it is paid later. Secondary market instruments. These are secondary market instruments traded in the stock exchanges, and standardized and customized. So they are standardized concept. There can be standardized derivatives like we have in forwards, and there can be customized derivatives like we have futures. Then participants in derivative market. The participants in the derivative market can be banks, financial institutions, corporate, brokers, etc. Hedgers. Mainly there are four types of participants in the derivative market. First one is hedgers. Hedger, he is a person who undertakes a position in future and also and other markets for purpose of reducing exposure to one or more types of risk. So if the intention behind going for derivatives trading is mainly to come out of some risk, or to get out of some risk, or to manage some risk, it is then you'll be hedger. Speculators are operators who are willing to take a risk by taking future position with the expectation to earn profit. So these are the people who speculate and earn profit. Arbitragers, they are the operators who deal in different markets simultaneously for profit and eradicate the mispricing of securities across the different markets. And then spreaders, he is a person who believes in lower expected return at the reduced risk. So he's reducing risk, and he's also believing in a lower expected return. He doesn't have a lot of requirement of profit, and he will be looking at lower risk and lower profit. Let us go for forward contract. What do we mean by forward contract? A forward contract is a customized contract between two parties to buy or sell an asset at a specified price on a future date. So important is it is a customized contract between two or more parties, then to buy or sell an asset at a specified price and at a future date. A forward contract can be used for hedging or speculation, although its non-standardized nature make it particularly apt for hedging. The forward contract is the informal over-the-counter financial market by which contracts for future delivery are entered into. Standardized forward contracts are called future contract and traded on the futures exchange. Now, features of forward contract. Bilateral contract, they are exposed to counterparty risk for non-performance of obligation on the either part of the parties. Each contract is custom designed, are unique in the terms of the contract, size, expiration date, the asset type, quality, etc. A party with no obligation of setting the forward contract is said to have an upper position. A party with a closed position is called hedger. The contract has to be settled by the delivery of the asset on expiration date. It is popular in foreign exchange market as well as in interest rate bearing instruments. What is futures contract? A futures contract is a legal agreement to buy or sell a particular commodity or asset at a predetermined price at a specified time in the future. Futures contracts are standardized for quality and quantity to facilitate trading on the futures exchanges. Two parties transact a contract party A and B. It is implemented as two contracts. So clearinghouse comes in between and it plays its role to settle the contract, to settle the transaction, whatever is happening. Essential features of futures contract. Tick size. A minimum amount is decided by the exchange. So there has to be a minimum size, minimum amount on the basis of which future contract can be done. Striking price, the price of the underlying asset specified in the contract. Delivery price. Delivery will take place in future and expiry date is specified by the exchange. Margins are payable by both the parties to the exchange, and the price limits can be decided by the exchange. So these are the essential features of futures contract. Kinds of future contract, there can be commodity futures, there can be financial futures. Commodity futures are grains future, metal future, energy future, soft future, livestock futures. Financial futures can be forex futures, interest rate futures, index futures, and single stock futures. So these are, and third one is a single stock, and one single stock future. Fourth one is a single stock futures. Now let us distinguish between futures and forwards. Futures, they are traded on exchange. Forwards, they are traded over the counter market. Our futures are standardized, forwards are customized. Identity of counterparties is irrelevant in identity of counterparties is irrelevant in futures, and identity is relevant in forwards. Futures market is regulated because it is exchange traded. Forward market is not regulated because it is over the counter. Mark to market for futures because there is no end date, so it is mark to market every day, and no marking to market is done in forwards because there is fixed date of execution of the contract. It is easy to terminate futures because they are exchange traded, difficult to terminate forwards because they are over the counter traded. And futures are less costly, but forwards are more costly. Now let us understand about the future trading mechanism. We'll understand this in the second part of the unit 2 of this video. By then, for the time being, just go through these videos and try to revise. Thank you. Have a nice time.